Today we are looking at stocks that insiders are selling. We're running them through the screener. We're looking at any company which has a market cap above 10 million, of which insiders are selling 200,000 shares or more. As always, we're going to start off by looking at each individual company, looking at their historical performance over the last few years. We're going to look at their dividend safety. We're going to take a look at their financial metrics to see whether or not these are strong companies. And as always, we will run them through the valuation model, getting to the intrinsic value as well as that acceptable buy price, given the investor margin of safety, as well as seeing what Wall Street are forecasting over the next 12 months. So the first company where insiders are selling, it is Procter & Gamble company. Now this is one that is up around 11% over the last year. It is heading towards its 52-week highs with a yield of 2.41% and a forward PE of 24.28. Now, if you've been a shareholder of this company over the last 10 years, you would be up around 104%. Do bear in mind that doesn't include those dividends reinvested, and we can see all-time highs around January 2022 at $163, so it isn't too far off. In terms of dividend safety, well, it has a score of 99. It is very safe. Market cap 367 billion, a mega cap company. Now, in terms of those recessionary metrics for those that see a recession inbound in 2024, while they increased the dividend during the last crash, they had an average growth negative 9%. The majority of companies in the S&P in the recession had negative 12%, and they also outperformed the S&P negative 36% return versus the S&P's negative 55%. Dividend growth, it wasn't the greatest increase last April at 3%. Remember, on the channel, we do advocate 4% or more to keep up in line with inflation. Last 5 years, 6%, not too bad. Last 20 years, 8%. We would like to see more of this going forwards, high single-digit increases to their dividend. But it is important to note they are a dividend king. They have increased those dividends for the last 50 years or more, and they've paid a dividend for the last 133 years without a reduction, an absolutely incredible feat. In terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So 2.41 versus 2.49, we could argue reasonable valuation at current prices. Forward PE, 23.3 versus 24, fairly reasonable. So overall, dividend yield theory is stating reasonable valuation. Do bear in mind that we don't look at any of these models in isolation. We will draw conclusions towards the end. Consumer staples sector P also sits slightly lower at 19.2. In terms of free cash flow versus earnings payout, as always, for new investors and new viewers, we do ignore earnings data. It is susceptible to manipulation by management through accounting. Free cash flow, a lot more relevant and accurate, below 70% for consumer staples. I personally like to see below 60%. It does give me faith management are able to essentially offer double-digit increases. Last 2 years, 63%. I do quite like that, and it's positive to note 2024, it is expected to be 58%, so below that 60% target, so that is good news in my opinion. Free cash flow per share, 362 in 2014, 582 in 2023. It has been increasing over the period. Yes, it isn't massively consistent, but it is moving in the right direction. 2024 expected to go higher to 650, so that is positive to note. In terms of sales growth, as always, we do like to see steady, moderate growth of around 3 to 7%. Now, what we can see over the last few years, it has been around that. 2023, it did dip slightly lower at 2%, and 2014 to 2017, we did see negative growth. One thing just to understand with the products that Procter & Gamble do sell, with inflation increasing, they do need to continue to increase those prices. So you could argue some of their consumers may look away to cheaper alternatives, which could impact their top line. Numerically, 74 billion to 84 billion in 2023. In terms of shares outstanding, well, they do share buybacks. They do return excess cash to investor pockets, 2.9 billion to 2.47. Whilst it's not consistently very, very large share buybacks, overall it is still a positive for the shareholders. ROIC, again, this is one of those metrics that I need to personally see 10% or more year on year. It does give me faith that management are able to effectively allocate their capital. Two things to note with Procter & Gamble. The first, consistently above 10%. The second, it is increasing as well. Very positive in my opinion, especially when you consider management. So that is a tick when I do look at Procter & Gamble in the investment thesis. Operating margin actually very positive as well, very consistent, and again moving in the right direction. 23% in 2023, lots to like there. And the free cash flow margin consistently above the minimums, 2023 at 18% as well as the previous year, looking very strong and pretty consistent. Now, what I also like about Procter & Gamble, when we look at their net debt to EBITDA, earnings before interest, tax, depreciation, amortization, we notice two things, and it does essentially relate to the balance sheet strength as well as dividend safety. These are the number of years it would take them to pay off all of their debt net of cash on hand. Now, for consumer staples, we look for below 4. What we can see here is 1.39 in 2023, expected to go lower in 2024, and consistently very low, so it's very positive. We can see why the dividend is very safe, and that balance sheet does look to be very strong. So let's jump into the valuation for Procter & Gamble. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically for each of these deep dives that we run into these companies, we do go through each model. For today's episode, we're going to jump straight into the intrinsic value, which for Procter & Gamble is in today's episode $168. Now, we can see the current price at $156. Typically, margin of safety, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see for Procter & Gamble right now, it isn't even a 10% margin of safety. At 5% it is. Now, this is one that I do hold. So in terms of my strategy, I have been buying this at a much lower price than the current trading value, and I would be looking for a far more significant margin of safety at a minimum 20%. So for me to add to my current position of Procter & Gamble, that is just my personal own thesis. I would be waiting for around $130 or $35, and we can see right now it's only at a 5% margin of safety. In terms of Wall Street and their price target, well, they see Procter & Gamble going to $169 over the next 12 months with upside of 8%. As we go through these companies, do let me know if you are looking to buy any of these or maybe looking to sell, or even possibly like me, just holding and waiting for a better price. The next company where we have a lot of insider selling, it is Caterpillar in the construction industry. Again, it is up 14% over the last year. It is trading at the 52-week highs with a yield of 1.74% and a forward P of 14.5. Over the last 10 years, it is up 219%. It's also important to note that this doesn't include those dividends reinvested. Dividend safety, another one with a very safe dividend score. Market cap, $152 billion, a mega cap company. Now, in terms of those recessionary metrics, well, they increased the dividend in the last recession, below average growth, and also significantly trailed the S&P with their negative 70% return. Nice dividend increases last summer, 8.3%, last 5 years, 9%, last 20 years, 10%, so that is very positive to note. It is a very nice dividend growth company, and they are also a dividend aristocrat. They have increased those dividends for the last 25 years or more. In terms of dividend yield theory, well, we see our first sign of overvaluation, 1.74 yield versus 2.26, but we do note the forward PE is sitting slightly lower at 14.6 versus that 5-year average of 15.1. In terms of the industrial sector PE, well, it does come higher at 19.4. Looking at that free cash flow payout, it is nice to see that it is below 60%. A lot of people will go industry specific and want to see below 40%. But for me, in 2022, 48% is sufficient. And we can see in 2023, when the annual report comes out, they are expecting 30% to that payout ratio. In terms of free cash flow per share, now what this signals to me, and we will be able to identify this, but this is a very cyclical company due to the industry. Therefore, we don't see consistent growth or growth moving in the right direction. We see it, in fact, from 2013 dropping down to 2016 before picking up. And we can see this very clearly from the sales growth data that we have. A few years of double-digit negative growth followed by double-digit positive. So one thing I do consistently say with cyclical companies, always try and buy them when they are out of favor. As we can see, this would be around times where we see negative growth. Right now, based on the last 3 years, we are seeing double-digit positive growth. So something just to consider whether or not you do believe that they are very much in cycle and you want to wait for when they become out. Total sales, then we do see that very nicely numerically. Shares outstanding, they do share buybacks. We can clearly see 659 million shares outstanding to 517. ROIC, very positive in my opinion. We are seeing double digits over the more recent period, 24% expected in 2023. Although we do note from 2013 to 2017, it was very inconsistent. Something just to keep an eye on, but it's no surprise that their ROIC also follows the cyclicality of the industry and company specific. Operating margin, very inconsistent, something just to keep an eye on. It is very positive to note that 2023, we do see a nice operating margin of 21%. But again, when it is out of cycle, we do see much lower operating margins. But it's nice to note on the free cash flow margin side, consistently above that minimum 5%. So regardless of the cycle, Caterpillar does have a very strong free cash flow margin. Net debt to EBITDA, very, very nice. We look for below 2.5 for heavy equipment makers. 2023 expected 0.47, so this is why we do see that very safe dividend score. And it is no surprise that we should be expecting at a bare minimum a high single-digit increase to the yield. So let's jump into the valuation for Caterpillar. And for those that are interested, if you do want to grab a copy of the valuation model to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So we start off with a margin of safety of 10%, and we can see it isn't warranted. At 5%, we can see it is a few dollars shy. So we believe there is just about or around 5% margin of safety for Caterpillar. In terms of my strategy, this isn't one that I hold. It is one that is on my watch list, but only when this company does become out of cycle. As and when I do believe that, I will definitely be dropping a video to let you know and letting you know whether or not I am adding at those prices. In terms of Wall Street and what they forecast, well, they see, in fact, negative 1% upside to this company at $295. So do let me know if Caterpillar is one that you do hold and whether or not you are considering selling it or maybe just holding at these current levels. The next company that we are taking a look at for insider selling is BlackRock. Now, over the last year, they're up around 4%. They are towards the upper end of the 52-week range with a yield of 2.6% and a forward PE just below 20. Over the last 10 years, they are up 162%, but they are a little way away from their all-time high at just under $1,000 in November 2021. In terms of their dividend safety, well, it's another one with a very safe dividend score, market cap 117 billion, and we can see those recessionary metrics. Whilst they maintained the dividend and had average growth during the period, they did beat the S&P, although marginally at negative 50%. In terms of dividend growth, well, 2% increase in Jan this year, so they have just recently increased it. Very mediocre in my opinion. The yield is already low, and then to have an increase below inflation is a little bit of a sour taste in the mouth. The last 5 years, well, double-digit increase, and last 20 years as well, which makes it a bitter pill to swallow seeing how low it was this year. In terms of increases, well, they have increased those dividends for the last 14 years. When we take a look at dividend yield theory, we do see that reasonable valuation with the current yield roughly in line with the 5-year average, and the same could be said for the forward PE. In terms of the sector PE comparison, though, the financials is significantly higher at 11.1. In fact, BlackRock is significantly higher, 19.1 versus the financials 11.1. In terms of the free cash flow payout, well, below 50% is the target for asset managers. I'm willing to take that up to 60%. 2022 slightly higher at 67%. 2023 expected 79%, which does make sense as to why we saw that 2% increase this month. In better news, it is expected to come down to 48% in 2024. In terms of free cash flow per share, well, inconsistent, but on a better note, it does increase over the period. But one thing to point out is in 2023, they are expecting their free cash flow per share to be lower than 2022's figure. In terms of sales growth, well, the period from 2014 to 2021 was nice to see. Unfortunately, 2022, it did drop. 2023, it was flat, which is understandable given that the share price did fall from their all-time high not too long ago. And we can see this numerically, their top line has nearly doubled from 11 billion to 18 billion. They also do shares outstanding reductions. They have done buybacks, 171 million. In fact, buying back around 20 million shares, currently sitting at 151. ROIC, now again, this really comes down to your investment thesis. I say 10% or more. Some people like to bring it to 25% for asset managers. But one thing I would note here, it is very consistent around that 12 to 15% year on year. And consistency, if the figures are positive, is one thing I do quite like to see. In terms of operating margin, free cash flow margin, very, very positive, well above the minimums on the operating. And on the free cash flow, whilst they do struggle sometimes, more often than not, we do see some very strong numbers. Net debt to EBITDA, absolutely phenomenal, 0.4, which shows us that realistically they have a very strong balance sheet and that dividend does remain to be very safe, with a reduction expected in 2024. So taking a look at their essential valuation, let's take a look for today's episode. The intrinsic value for BlackRock is coming to $820. Now we do start off with a margin of safety of 10% as always, and we can see it isn't right there yet. At 5%, it's around $10 shy. So again, similar to the previous company, Caterpillar, we only see a maximum of 5% margin of safety. In terms of Wall Street, well, actually, they do see some nice upside to BlackRock. They see 15% with a price target of $905. Do let us know. A lot of people do like BlackRock in the dividend community. Do let me know if you have been adding these, as they were much lower than they are currently now, not too long ago. Now, before we move on to the next company, just to let you know, we have started a free weekly newsletter. The link is below. Last week's edition was discussing an undervalued company with some strong upside, and week one we ran through our 7 golden dividend metrics. Completely free newsletter. If you do want to grab a copy, do click on that link below. So the next company we're going into for insider selling is Walmart. Now, over the last year, it is up 16%. It is towards the 52-week highs, and we see a yield of 1.4% and a forward PE of 25. Over the last 10 years, this company is up 120%, pretty much towards its all-time highs. And when we take a look at that dividend, again, another very safe dividend score of 90, market cap 442 billion, so it is a mega cap company. In terms of recessionary metrics, well, this is one of the best recessionary metrics you will see that we have analysed. Increased the dividend during the last recession, above average growth, and probably one of the few that had a positive recession return, 7% versus the S&P's negative 55. Dividend growth, well, very mediocre, 1.8% last February, so we are expecting an increase in the next few weeks. 2% over the last 5 years, but over the last 20 years at 11%, whilst that is good, that was a long time ago, so we would like to see these increases in the more recent and relevant period. In terms of dividend growth streaks, well, they are 1 year away from becoming a dividend king. When they do increase that dividend, we do hope to see next month, they will enter that dividend king status. In terms of dividend yield theory, well, we have that sign of overvaluation / slight reasonable valuation, 1.39 versus 1.59. And we do note the forward PE pretty much in line with that 5-year average. In terms of the comparisons, well, we do see Walmart slightly higher than 19.2's consumer staples sector PE. When we take a look at the free cash flow payout, the last 2 years below 60%, 2024 expected 43%, so that it is positive. It just does make me a bit disappointed to see that mediocre increase last year. In terms of the free cash flow payout, very inconsistent. Yes, it does increase over the period, but still there are a lot of inconsistencies where it does shoot up before coming back down like we saw in 2021, 2022. 23, however, positive at 440. 2024, they are expecting in the $5 region, so that is nice to see as an investor or potential investor. Steady moderate growth, remember, 3 to 7%. The last 4 years looking very positive around those levels, but something just to keep an eye on, as it is very easy for that to slip. Total sales, then, we do see it increase from 476 to 611. They also do buy back a fair amount of shares, returning excess cash to those investor pockets at 3.28 billion to 2.7 currently. Now, when we do analyse the ROIC, it is above that 10% consistently, the most recent period at 16%. So personally, for me, Walmart, their management team is looking fairly good so far. Now, in terms of these type of companies, this is one they do really struggle at, consumer retails. We do like to see 10% or more, but we can see it has been reducing every single year. It is at 4% now in 2023. Something just to be aware of, if their margins do start to squeeze, that will heavily impact the investors and dividends. Free cash flow margin, again, not the greatest. So these are the two probably worst metrics of Walmart. And if you are an investor or thinking to become one, do keep a close eye on these as the annual reports do come out. Net debt to EBITDA, though, at 1.35 is nice to see. So that dividend does look to be safe and the balance sheet does look to be in good hands. So in terms of their valuation, let's take a look, and we can see for today's episode that Walmart's intrinsic value comes to $191. So when we take a look and we put in the margin of safety of 10%, we can see it is a buy at a 10% acceptable buy price. At 15%, it is $1 or $2 shy. So we see around 15% in terms of margin of safety. In terms of what Wall Street expect, well, they do see a fair amount of upside, not the greatest, but they do have a price target of $180. We then have a new company on the channel which we have not reviewed before, Farsal company. Now they are up an incredible 39% over the last year, again towards their 52-week highs, with a yield of 2.3% and a forward P of 32. Over the last 10 years, they are up around 216%. So let's take a look. Another very safe dividend score at 81, market cap 39 billion, a large cap company. Looking at those recessionary metrics, well, they increased the dividend in the last recession, below average growth, but they did beat the S&P with their negative 45% return. Lots to love here. They increased the dividend this month 11%, last 5 years 13%, last 20 years 22%. Very, very nice. Probably the best dividend growth company we have analyzed in today's episode. And on top of that, they are a fresh new dividend aristocrat. Now let's take a look at dividend yield theory. We can see a sign of reasonable valuation. The yield isn't too far off the 5-year average. Likewise on the forward PE. But when we compare it to the industrial sector PE, we do see Farsal significantly higher at 31.8. Now, in terms of the free cash flow payout, very, very inconsistent. This is why we do look at the free cash flow. Remember, over 100% is a massive red flag. It means management are paying out more in dividends than generating in free cash flow. 2023 at 63%, just something to be aware of, which is positive. But again, 2024, it looks like it could be creeping back up. Just something to keep an eye on moving forwards. Free cash flow per share, very nice increases over the period. It is inconsistent, but it still increases very strongly, more than 4 times growth over the last 10 years. Sales growth, another one that looks to be very good. Double digits a few of the last 10 years. 2023 at 5% is still not too bad, as remember, for steady moderate growth, we do target 3 to 7%. We also see their top line pretty much doubling over the last 10 years. And one thing that they don't do that consistently or regularly is share buybacks, but you can see over the last 10 years, the net position would be a net share buyback. Now let's take a look at the ROIC, absolutely phenomenal. Now, this is what you should be thinking when we're looking at these companies. What are some of these metrics that do stick out in all of the very strong companies? This is one of them, the ROIC, in the 30s pretty much every single year over the last 10 years. Operating margin, free cash flow margin, phenomenal. I just love to see this consistency, very, very strong. Free cash flow margin has been increasing over the last 10 years. So there is a lot to love with this company. And we can see 2023 at 0.18, absolutely phenomenal. But remember, the most important thing, once you have identified a very strong company that you do want to invest in, is that valuation. So let's take a look at the valuation, and remember, you can grab a copy of the valuation model to get to the intrinsic value as well as that acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment. Margin of safety at 10%, then we can see it's a few cents shy, so we do see Farsal having around 10% margin of safety. In terms of Wall Street and what they forecast, well, they have a price target of $71, so they see upside of 3%. Now, whilst this isn't one that I personally will be investing in, it does go to show when we do look that sometimes when insiders do sell, it does hit that 52-week high point. Now, one thing that is important, I do want to make you understand, just because insider sells, it doesn't mean it's a bearish signal. They sell for many reasons. They sell for personal reasons, financial reasons. And in fact, we have gone through and looked at insider selling and have noted for the majority of times in the more recent period, the share price has gone and continued to climb further than when they did initially sell. A lot of food for thought. Let me know your thoughts on this in general, whether or not you enjoyed today's episode. Smash that like button, hit the subscribe and bell button. As always, we will see you on the next one, and take care for now.